Thank you for joining us. During this presentation, we'll cover a number of topics, including what are the factors that are creating the current volatility, how the negative recent performance fares in conjunction with performance over the last few years since COVID became a factor, how the performance to date, including the recent volatility, shows a normalisation of long-term returns, focusing on the long-term objective and not being distracted by the short-term noise, and how short-term negative performance can still often lead to a positive one-year outcomes, hence demonstrating the importance of patience and tolerance. The key factor driving current outcomes surrounds government and investor concerns in relation to inflation, as a long-term high inflationary environment can cause significant disruptions to well-functioning economies. Currently, inflation has hit a 40-year high both in Australia at 5.1% and globally, with the US inflation exceeding 8%. These inflationary concerns and outcomes have resulted in a perfect storm of situations that individually have minor inflationary impacts, however together accentuate inflationary outcomes. These situations, amongst other things, include the war in Europe, which is causing supply issues with major commodities, including oil, through distribution and sanction issues. The most significant government stimulus we have ever witnessed, providing an excess supply of liquidity to consumers to spend in an attempt to keep the economy going during the concerning COVID period. And rising house prices, giving people confidence in their increasing net wealth position, resulting in a greater comfort for people to spend. To manage the inflationary concerns, governments are using monetary policy, which is basically increasing interest rates to reduce people's spending habits to gradually take some of the heat out of the economy. Increasing interest rates reduces available liquidity and increases borrowing costs, making investors more cautious as they consider how businesses will handle the changing economic circumstances. This prospective situation is the primary driver behind the volatility we are currently experiencing. In light of those issues, the most important thing from our clients' perspective is to maintain patience and tolerance during these challenging times. It is these times that we can help navigate you through, make sure that you feel comfortable, and ensure that your long-term objectives are not going to be compromised.
It is important to remember that share markets significantly outperformed their long-term average returns in the years leading up to 2022, despite ongoing volatility as a result of COVID-19. This has resulted in a normalisation of returns over the last 3 years, as the performance of equities over this timeframe is broadly consistent with the long-term average returns that would be expected from growth assets. To illustrate this, the top 500 companies in the US generated a return of 11.5% per annum for the 3 years to 31 May 2022. When we look closer and dissect the performance of US shares over this timeframe, we can see that markets performed strongly in the lead up to COVID-19 before falling approximately 30% in 1 month, as fears of the health and economic impacts of the pandemic reached a peak. Fast forward 2 years and the global recovery from COVID-19 has been as good as we could have hoped for, thanks to enormous levels of stimulus and better than expected health outcomes, with markets more than doubling in value from their COVID lows to December 2022. Whilst this has been a great success story, it has meant that economies have overheated, as the enormous stimulus packages, combined with countries returning to full employment, have resulted in excess demand that has led to high inflation levels. This is evidenced on the charts by the strong performance from March 2020 to the end of 2021, where performance was significantly greater than long-term average returns. However, the downside of this high demand and an ongoing supply shortage is that inflation has persisted and at higher levels than anticipated. As a result, some of the strong gains that were generated have been pared back, resulting in a 3-year return that is consistent with longer-term averages, despite heightened volatility over this timeframe. As such, when we look at performance over the medium term, investing in shares has still provided a significant premium over defensive assets, such as cash and fixed interest, even though we have seen 2 significant periods of negative returns in a relatively short space of time. When we extrapolate this further, as shown by the straight lines on the charts, we can see markets are now priced in line with long-term growth trends before COVID-19 dominated headlines and the flow-on effects impacted markets. Given this, we believe markets are now fairly priced and present an excellent opportunity for long-term investors moving forward, despite expectations for volatility to continue in the short term.
Markets are always moving up, down and sideways. While unsettling, market volatility is inevitable and completely normal. The challenge for investors is to not let market declines get them off track as they seek to achieve their long-term goals. Because time after time, stock markets have recovered from the disruptive but ultimately short-term declines and gone on to post gains. The S&P 500 chart on screen demonstrates that short-term market movements are very difficult to predict and happen very regularly, but also show that historical market returns have been positive despite negative short-term market corrections. The grey dots depict the biggest decline in markets each calendar year, and the blue bars represent the return achieved over the course of the calendar year. To relate to the current market conditions, you can see how regularly markets retreat to double-digit negative returns, for example, have occurred 4 times in the last 7 years alone. However, despite these negative corrections, markets have generated overall positive returns in 5 of the 7 years. Specifically looking at 2020, markets retreated almost 35%, however finished the year with an overall positive return of 16%. In summary, given markets often decline, it is vital to avoid the trap of selling down. This will ensure that you not lock in any losses and miss out on any of the ensuing gains. It is important to stay focused on your goals, maintain a disciplined approach, and receive the long-term benefits of a diversified portfolio. We are a firm believer about it's not about timing the market, but about time in the market. Research shows that those that stay invested over the long term in a well-diversified portfolio will do better than those who try to profit from those turning points in the market.
In summary, we are very conscious of the current volatility that is being experienced throughout markets, and understand that some of our clients may feel some level of nervousness during these times. As demonstrated throughout this presentation, we are continuously monitoring current market conditions and key economic factors, and remain extremely comfortable that markets will return to their long-term averages despite these current lows that we're experiencing. Importantly, all of the advisors at Custodian Financial Group ensure that we establish and maintain portfolios that are consistent with each of our investors' individual long-term investment timeframes and objectives, to ensure that these short-term market movements do not impact their lifestyle and financial goals long-term. Now, as you may have seen in our email, we have provided a few links to our YouTube videos, which you can also find on our channel, which go through a couple of the key concepts that we look on a day-by-day basis. Firstly, we have provided a link to a video explaining the benefits of staying invested during these choppy times, which forms a lot of the basis behind the concepts that we've gone through today. Secondly, we've provided a in-depth video about our waterfall structure, which we currently utilize for a fair chunk of our client portfolios. Lastly, should you have any questions following the presentation today, please do not hesitate to reach out to your advisor, and we look forward to catching up soon.